On a Sunday evening in August 1971, President Richard Nixon appeared on television and casually announced he was breaking a promise the United States had kept for 27 years. Within minutes, he had severed the last thread connecting the world's money to anything real. Most Americans eating dinner had no idea their dollars had just become pure belief. The promise began in July 1944, before World War II had even ended. Delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. The war had shattered the global economy. International trade had collapsed. Currencies were worthless. Nations hoarded gold and trusted nothing else. The American delegation, led by Treasury official Harry Dexter White, proposed a solution. The United States held over 20,000 metric tons of gold in its vaults, more than any nation in history. White offered a deal. America would fix the dollar's value at $35 per ounce of gold, and foreign governments could exchange their dollars for actual gold bars any time they wanted. Other nations would then peg their currencies to the dollar. This simple mechanism would restore trust and rebuild world trade. The other nations agreed, but only because America's promise seemed unbreakable. Fort Knox held physical gold. The convertibility was guaranteed. You could walk into the U.S. Treasury with dollars and leave with gold bars. That physical anchor was the entire foundation of the system. For the first decade, the system worked exactly as designed. The United States ran modest trade surpluses. Foreign governments accumulated dollars gladly because those dollars were as good as gold. The dollar became the world's reserve currency. International trade flourished. The promise held firm, but in the late 1950s, something began to shift. The U.S. government started spending more than it collected. The Korean War, domestic programs, military bases across Europe and Asia. Dollars flowed out of America faster than gold flowed in. By 1960, foreign governments held more dollars than the U.S. had gold to back them. French President Charles de Gaulle noticed first. He saw the mathematics clearly. America had extended promises it couldn't possibly keep. In February 1965, de Gaulle announced that France would begin converting its dollar holdings into gold. He called the Bretton Woods system an exorbitant privilege that let America print money while other nations had to earn it. The Bank of France became relentless. Every month, French officials arrived at the Federal Reserve Bank of New York with dollars and left with gold bars. In May 1971 alone, France converted $191 million into physical gold and shipped the bars from New York to Paris vaults. Other nations watched and followed. Germany, Switzerland, the Netherlands. The gold drain accelerated. By early 1971, the mathematics had become impossible. The United States held 8,100 metric tons of gold. Foreign governments held claims on over 40,000 tons worth of dollars. The gold reserves could cover less than 20% of America's obligations. Every central banker in the world could see the numbers. The promise couldn't be kept much longer. Then came the critical moment. In early August 1971, the Bank of England requested $3 billion in gold conversion. Treasury Secretary John Connolly looked at the numbers and realized the truth. If Britain got its gold, the vaults would be nearly empty. Every other nation would rush to convert before the gold ran out. The game was over. On Friday, August 13th, Connolly flew to Camp David, where Nixon was spending the weekend. They gathered Nixon's top economic advisors in secret. Federal Reserve Chair Arthur Burns was there, Budget Director George Shultz, Chief Economist Paul Volcker. They reviewed the situation through Friday night and all day Saturday. Connolly laid out the stark reality. America faced a choice: raise taxes dramatically and cut spending to restore balance, accept a humiliating devaluation of the dollar against gold, or break the promise entirely and close the gold window. The first option was political suicide. The second option was international embarrassment. The third option was unthinkable, until it became the only option. Burns warned of international chaos if they closed the gold window. Europe would be furious. Japan would feel betrayed. The entire Bretton Woods system would collapse overnight. Volcker, younger and more pragmatic, argued they had no alternative. The gold was gone. The promise was already broken. Better to acknowledge reality on their own terms than wait for a catastrophic run on the remaining reserves. Nixon made the decision Sunday morning. They would close the gold window immediately and announce it that night before Asian markets opened Monday. No advance warning to foreign governments. No international consultation. A clean break, presented as a temporary measure. At 9 p.m. Eastern Time on August 15th, Nixon appeared on television. He spoke for 18 minutes about jobs and inflation. 13 minutes in, almost as an afterthought, he announced that the United States would temporarily suspend convertibility of the dollar into gold. He called it a defense against international speculators. He promised it would strengthen the dollar and protect American workers. What Nixon didn't mention was that temporary meant permanent. The gold window, once closed, would never reopen. The physical anchor that had connected money to reality for thousands of years had been severed. From that moment forward, the dollar's value rested purely on trust in the U.S. government's ability and willingness to limit its creation. Foreign governments reacted with shock and anger. The British Treasury called it a betrayal. Japanese officials felt blindsided. European central banks scrambled to understand what their dollar reserves were now worth. Within days, currency markets descended into chaos as decades of fixed exchange rates collapsed. But in America, most people barely noticed. The stock market jumped the next day, celebrating what investors saw as freedom from golden constraints. Economists debated whether Nixon had made a bold move or a catastrophic error. And deep in the U.S. Treasury, officials began to understand what they had actually done. They had removed the last brake on money creation. For the first time in American history, there was no physical limit to how many dollars could exist. No gold reserve requirement to meet. No foreign government that could demand real assets in exchange for paper. The government could now create as much money as it wanted, whenever it wanted, for whatever reason it wanted. The only question was, what would they do with this new power? The answer came quickly. In 1971, the federal government spent $23 billion more than it collected in taxes. That deficit seemed large at the time. Congress debated it. Newspapers called it reckless. But something had fundamentally changed. Without the gold constraint, that deficit didn't require finding $23 billion of real savings from real people. It just required creating new money. The mechanism works like an elaborate shell game that most people never see. Here's how the system actually operates. When the government wants to spend more than it collects, the Treasury Department issues bonds, essentially IOUs, promising to pay back the money with interest. These bonds get auctioned to primary dealers, which are large financial institutions like J.P. Morgan, Goldman Sachs, and Citigroup that have special privileges to trade directly with the Federal Reserve. These primary dealers buy the bonds at auction, knowing they can immediately turn around and sell many of them to the Federal Reserve. And here's where the magic happens. The Federal Reserve doesn't need to have money sitting in an account to buy these bonds. It simply credits the dealers' accounts with new digital dollars that didn't exist a moment before. The government gets its spending money, the banks collect fees and interest on both sides of the transaction, and new dollars flood into the financial system. Before 1971, this mechanism had a hard limit. The Federal Reserve couldn't create unlimited money because it had to maintain gold reserves backing the dollars. After August 15th, that limit vanished. The Fed could expand its balance sheet indefinitely. The only constraint was political will, and political will is far more flexible than physical gold. The 1970s proved how quickly the new system would be exploited. Government spending accelerated. The deficit, in 1975, reached $53 billion. By 1976, it hit $73 billion. The Federal Reserve accommodated this spending by expanding the money supply. More dollars, chasing the same amount of goods, meant rising prices. Inflation jumped from 3% in 1972 to 11% by 1974. It fell briefly, then surged again to 13% by 1979. Workers saw their paychecks buy less every year. Savings accounts lost value despite earning interest. Retirees on fixed incomes watched their purchasing power evaporate. The dollar lost half its value in a single decade. Paul Volcker, who had been at Camp David for Nixon's decision, became Federal Reserve Chairman in August 1979. He understood the credibility problem. If the Fed would create unlimited money to finance government spending, the dollar would eventually become worthless. Volcker made a dramatic choice. He raised interest rates to 20%, deliberately triggering a recession to crush inflation and restore some trust in the currency. The Volcker recession was brutal. Unemployment hit nearly 11%. Businesses failed. Families lost homes, but inflation fell from 13% to 3% by 1983. Volcker had proven the Fed could still constrain money creation if it chose to. The key word being if. Throughout the 1980s and 90s, the system operated with some restraint. The Federal Reserve's balance sheet grew slowly from $130 billion in 1979 to around $800 billion by 2007. Deficits existed, but stayed somewhat contained. The money printing press was there but used sparingly. Then came the financial crisis of 2008 and all restraint disappeared. In September 2008, Lehman Brothers collapsed. Credit markets froze. Major financial institutions faced bankruptcy. The Federal Reserve, now chaired by Ben Bernanke, faced a choice remarkably similar to what Nixon faced in 1971. Accept painful consequences or use the printing press. Bernanke chose the printing press. In November 2008, the Fed announced it would purchase $600 billion in mortgage-backed securities, the toxic assets that had triggered the crisis. This wasn't lending money that would be repaid. This was creating new money to buy assets that nobody else wanted at prices nobody else would pay. The program expanded rapidly. By 2015, the Federal Reserve had created $4.5 trillion, quadrupling its balance sheet in just 7 years. Primary dealers like Goldman Sachs and J.P. Morgan facilitated these massive purchases, collecting billions in fees while the Fed absorbed trillions in government debt and mortgage securities. The official explanation was that this quantitative easing would stimulate the economy by lowering interest rates and encouraging borrowing. That happened, but something else happened too. All that newly created money flowed into financial assets. Stock prices doubled, then doubled again. Real estate prices in major cities soared. Bond prices rose as the Fed became the largest buyer in the market. But wages barely budged. Median household income in 2015 was barely higher than in 2007, after adjusting for inflation. The money creation had inflated asset prices dramatically, while doing little for people who worked for wages rather than owned assets. The pattern was becoming clear. The printing press transferred wealth to those who owned assets before the money got created. Still, the 2008 crisis could be seen as an emergency measure, a one-time intervention to prevent collapse. Maybe the Fed would shrink its balance sheet back down afterward. For a brief period from 2017 to 2019, they tried. The balance sheet fell from $4.5 trillion to $3.5 trillion. Then came March 2020. The COVID pandemic hit. Governments ordered lockdowns, economic activity collapsed overnight, and the Federal Reserve responded with money creation that made 2008 look modest. In 9 weeks, the Fed created $3 trillion. The balance sheet exploded from $3.5 trillion to $7 trillion. Then it kept going. By April 2022, the Federal Reserve held $9 trillion in assets. nearly triple the pre-pandemic level. They were purchasing $80 billion in Treasury bonds every single month, plus $40 billion in mortgage-backed securities. The federal government, meanwhile, spent $6 trillion in fiscal 2020, nearly double the previous year. Where did that money come from? Not from taxes. Revenue actually fell. It came from borrowing, which meant issuing bonds, which the primary dealers bought, which the Federal Reserve then purchased with newly created money. The national debt jumped from $23 trillion in March 2020 to $28 trillion by March 2021. $5 trillion of new debt in 12 months, the fastest peacetime expansion in American history. And much of that debt ended up on the Federal Reserve's balance sheet, purchased with money that didn't exist until they created it. The consequences arrived as inevitably as they had in the 1970s. By 2021, inflation began rising, first 3%, then 5%, and then 7%. By June 2022, consumer price inflation hit 9.1%, the highest rate since Paul Volcker's era. Once again, the currency was losing value because too many dollars were chasing available goods. The Federal Reserve, now chaired by Jerome Powell, faced the same choice Volcker had faced. Powell raised rates from near zero in March 2022 to over 5% by 2023. Banks that had loaded up on low-interest bonds faced devastating losses as those bonds fell in value. In March 2023, Silicon Valley Bank collapsed after $42 billion fled in a single day. Depositors had figured out the bank couldn't survive rising rates. Within 72 hours, the Federal Reserve created a new lending facility called the Bank Term Funding Program, making $300 billion available to backstop banks holding similar problems. The pattern repeated again. Crisis emerges. The printing press activates. New money gets created. Those closest to the money creation get protected. Those holding dollars watch their purchasing power decline. By September 2024, the federal debt had reached $35 trillion. Annual interest payments exceeded $1.1 trillion, more than the government spends on national defense. Servicing that debt requires either raising taxes dramatically, cutting spending dramatically, or continuing to create new money to buy the bonds. Raising taxes is political death. Cutting spending means cutting benefits people depend on. So the printing press keeps running, just as it has since that Sunday night in 1971, when Nixon closed the gold window. The machine Nixon unleashed has only one direction: expansion. Each crisis provides justification for more money creation. Each round of money creation inflates asset prices and increases debt. Higher debt requires lower interest rates to service. Lower rates encourage more borrowing. More borrowing requires more money creation. The cycle feeds itself, growing larger with each turn. What started as a temporary emergency measure in 1971 became a permanent feature of the financial system. The printing press isn't hidden anymore. The Federal Reserve announces its asset purchases. The Treasury publishes debt figures. The mechanism operates in plain sight. The only question is who benefits from it and who pays for it. The answer reveals itself clearly when you track where the newly created money actually goes. It doesn't distribute evenly across the economy, like rain falling on everyone equally. It flows through specific channels to specific destinations, and those closest to the source capture the value before it dilutes everyone else's dollars. Start with the mechanics. When the Federal Reserve creates $3 trillion to purchase bonds, that money enters the financial system first. Primary dealers, the 24 institutions authorized to trade directly with the Fed, handle the transactions. They buy bonds from the Treasury, sell them to the Fed, and collect the spread. On $31 trillion in annual Treasury trading volume, even tiny spreads generate billions in essentially risk-free profits. But the real wealth transfer happens through what that new money does to asset prices. When the Fed buys $80 billion of bonds every month, it pushes bond prices up and interest rates down. Lower interest rates make stocks more valuable. Future corporate earnings become worth more and more when you discount them at lower rates. They make real estate more attractive. Mortgages become cheaper. letting buyers bid higher prices. They inflate the value of every asset that gets priced relative to the interest rate. If you owned assets before the money creation began, you win automatically. Your stock portfolio rises, your house appreciates, your bond holdings increase in value. You did nothing to earn this wealth. The system simply channeled newly created dollars toward assets you already held. The numbers from 2020 to 2024 make this pattern undeniable. The S&P 500 stock index stood at 2,480 points in March 2020 when the pandemic hit. By November 2024, it had reached 4,600 points, an 85% increase. Corporate earnings didn't rise 85%. The economy didn't grow 85%. But the money supply expanded dramatically, and much of that new money flowed into stocks. Real estate followed the same trajectory. The median home price in America was $320,000 in early 2020. By late 2024, it had jumped to $470,000, a 47% increase in less than 5 years. During that same period, the Federal Reserve's holdings of mortgage-backed securities grew from $1.4 trillion to $2.6 trillion. The Fed was literally creating money to buy mortgages, pushing up housing prices for everyone trying to buy a home. Meanwhile, median real wages, what workers actually earn after accounting for inflation, increased roughly 2% over those same 4 years. Someone who earned $50,000 in 2020 was making about $51,000 by 2024 in real terms. Their wages barely moved, but if they owned a $500,000 home, it was now worth $735,000. If they held $100,000 in stocks, it was now $185,000. The system rewards ownership, not labor. It channels wealth to those who already have assets to inflate. Consider the concrete example of Silicon Valley Bank's collapse in March 2023. The bank had loaded up on long-term government bonds when interest rates were near zero. When the Fed raised rates to fight inflation, those bonds lost substantial value. Depositors realized the bank couldn't return their money if they all withdrew at once. $42 billion fled in a single day. What happened next revealed who the system actually protects. The FDIC insurance only covered deposits up to $250,000. Most of Silicon Valley Bank's depositors were startups and tech companies with millions in their accounts. Those deposits were legally at risk. Shareholders had already lost everything. Bondholders faced losses too. But within 72 hours, the Federal Reserve and Treasury Department announced that all deposits would be protected, regardless of the insurance limit. They created a new lending program making $300 billion available to banks in similar situations. Depositors got made whole, not through insurance premiums or bank reserves, but through the creation of new money. Large depositors were rescued, but what about people whose savings lost 23% of purchasing power from 2020 to 2024, while their bank account paid 0.5% interest? No special program protected them. No emergency facility restored their purchasing power. They simply paid the hidden tax of inflation, while asset owners got richer and large depositors got backstopped. The pattern appears in every crisis response. In 2008, the Fed created money to buy mortgage-backed securities, protecting bondholders and large financial institutions. Homeowners still lost their houses. In 2020, the Fed created money to buy corporate bonds, protecting companies' ability to borrow. Workers still lost their jobs. In 2023, the Fed created money to backstop bank deposits over the insurance limit. Small savers still lost purchasing power to inflation. This isn't a political judgment. It's a mechanical description of how the system operates. Money creation doesn't help people evenly. It helps those who receive the new money first: financial institutions, large corporations, asset owners, before inflation dilutes the currency for everyone else. By September 2024, the Federal Reserve held $7 trillion in assets on its balance sheet, double the pre-pandemic level. The federal government owed $35 trillion in debt, requiring $1,100 billion in annual interest payments. That interest bill exceeded defense spending. It exceeded Medicare spending. It had become the second largest federal expenditure after Social Security. Here's the critical insight: that debt can never be repaid in full. The mathematics don't work. Paying off $35 trillion would require running massive budget surpluses for decades. But the government hasn't run a meaningful surplus since 2001. Instead, it runs trillion-dollar deficits every year, adding more debt that requires more interest payments. The only way the system continues is through more money creation. The Federal Reserve has to keep interest rates artificially low to make the debt serviceable. When inflation forces them to raise rates temporarily, they create new facilities and programs to prevent anything from breaking. Then they cut rates again as soon as possible. In September 2024, even with inflation still above the Fed's 2% target, they began cutting interest rates, not because inflation was defeated, because the debt burden had become too large to service at higher rates. The system had become trapped. It requires continuous money creation to survive. Understanding this pattern is genuinely empowering because it reveals exactly how the game works. Wealth isn't primarily created through hard work or innovation anymore, though those still matter. Wealth is increasingly created by positioning yourself on the correct side of the money creation machine. If you hold assets, stocks, real estate, even Bitcoin, you benefit as new money inflates their prices. If you hold only cash and earn only wages, you lose purchasing power as that new money dilutes the currency. This isn't moral judgment. It's mechanical reality. The system operates this way by design, though perhaps not by intention. The winners are clear: financial institutions that facilitate government borrowing, asset owners who hold stocks and real estate before money creation begins, large corporations that borrow at artificially low rates, government itself, which can spend unlimited amounts by creating money rather than raising taxes. The losers are equally clear: workers whose wages lag asset price inflation, savers whose cash loses value faster than it earns interest, young people trying to buy their first home while competing against money creation-fueled price increases, future generations inheriting debt obligations that exceed the economy's ability to service them through taxation. Most importantly, this pattern is permanent under the current system. There's no going back to the gold standard. The government would have to acquire thousands of tons of gold it doesn't have and accept spending limits it can't maintain. There's no political will to run the massive surpluses needed to pay down the debt. There's no way to service existing obligations without keeping interest rates artificially low through money creation. The machine Nixon activated on that Sunday night in 1971 has become the foundation of the entire financial system. It can't be turned off without collapsing the structure built on top of it. The only question remaining is the same question from that evening 53 years ago. Which side of the machine will you stand on? Nixon promised his decision was temporary, just long enough to stabilize the system, just until they could return to sound money. But there's no gold window to reopen now, no anchor to reconnect. The machine runs faster every year, and the entire economy depends on it never stopping. Those who understand the pattern can position themselves accordingly. Those who don't will keep wondering why everything feels harder, why their dollars buy less, why the gap keeps widening no matter how hard they work. The answer was given on a Sunday evening in August 1971. Most people just weren't paying attention.